great weekend, as well as all of the viewers. Good luck with your interview with Tom. He's awesome, by the way. Go follow him on Twitter. Real awesome resource. Nice interview that you landed here. So have a great one. Take care of yourself, and we'll be back next week.
All right. Like always, thank you, Ryan, and we'll have you back next week, my friend. The Lord is out there. Let's go ahead. Let's keep it going here, guys. We're going to be getting into an interview coming on next here. It's going to be Thomas J. Hayes, the chairman and managing member of Great Hill Capital. I've had him on Money Mitch before, and now we're going to bring him on live trading with Benzinga. Like always, guys, smash the like. Let's keep it going here. I'm going to go ahead and kind of just play a little bit of some action here, guys, and we'll be right back here. Play a little trailer action and get us going here. Let's go ahead. Hold on. Well, I got to fix my layout right quick. There you go. Boom, boom. All right, guys, we'll play a little trailer and we'll bring on Tom right now.
I tell all my CEOs, this is a very, very, very important platform. And look, all the other platforms are important too, but you're up there now. You're way up there.
Best investments you can do in your future is actually go and educate yourself on credible sites and credible resources like Benzinga. I think you guys have been killing it.
The comment section on this show is remarkable. Like the quality of the combo, and just big shout out.
All right, guys, let's go ahead. Let's bring on the one himself here. I've had him on before and excited to get into it. How we doing, Thomas?
Doing great, Mitch. Thanks for having me back.
Yeah, excellent to have you on, guys. And one of the things that I always pay attention when Thomas is putting out the heat map to give us a little bit of view of what's going on in the market, right? I mean, that's what I love doing, is definitely staying with where's the relative strength, because it's definitely something we all want to kind of keep an eye out. So, I mean, we started seeing a little bit of reaction. Some people were saying short squeezing yesterday. Some people were saying dash for trash. Were we oversold? How do you see this market right now, Thomas?
Yeah, well, Mitch, there's an old ancient Chinese proverb. It says, he who picks bottom gets stinky finger. I have a few stinky fingers in recent weeks. As you know, I've loved biotech. I've loved China tech. A little bit early for sure. But what you're seeing this week as rates start to stabilize, what are the number one and number two producers the last few days have been? Biotech, the XBI, and KWeb, and BABA's up nicely today. So I think what you had here was less of a crypto winter and more of a margin winter in recent weeks and months. And what I mean by that is that the 10-year yield literally skyrocketed from 137 basis points in December to 319 basis points earlier this week. It backed off below 3% yesterday, closed out at 282. I think it's at 290 today. And if that 10-year yield can stay below 3% and stop going up, and I think with the PPI and CPI numbers coming in less than last month, we could see a real bid back into everything that was left for dead due to tightening fears and the rise in rates. And what does that mean? What's sold off? Well, the biggest things that have sold off, obviously, are tech, biotech, China tech, innovation stocks, which I'm less sanguine on, and even crypto. So long duration speculative assets should start to get a bid, provided the 10-year yield stays below 3.
Yeah, I think that's definitely something that's been on watch. It's been on both sides. I mean, there's not often that we see, equities taking such a hit and also the bond market taking such a hit. So it's interesting that you're calling out there. We'll be paying attention to see what happens in the Qs. Right now, I'm taking a look at them, and it's been straight up, at least for today. I've been looking to see how the leadership would do, right? I mean, I wanted to take a look at some tech names and see how we were going to be bouncing back. Apple showing up there towards 147 today, not looking too bad. And how are you seeing our leadership in tech?
Yeah, I think you definitely want to see the generals start to get bid. I mean, some of these have come down. They're trading Fangam, FAANGM, including Microsoft. They're trading at 29% below their average multiples of the last 5 years. And a lot of that was rate hike fears. And I think it's absolutely overdone. So we definitely need to see the strength in Fangam. The other thing that is critical here is that this market got a little overdone on those rate hike fears. And the reason I say that is because it all comes down to earnings. And earnings have come in a little bit in the last week. I will say that they came consensus for 2022 came down from 230 to 229. That's not great news. But on that basis, we traded at about 17 times 2022 earnings this week, and we got down to 15 and a half times 2023 earnings, which is exceptionally low considering the average multiple for the last 5 years, Mitch, is 18.6 times. And that includes the last tightening cycle, which went from 2016 to 2018. So for everyone saying that these generals can't do well with the 3% 10-year, they just don't follow history, because the 10-year peaked in October of 2018 at 325. It also peaked previously in January of 2014 at 303, and we got up to 319. Now we're back to 290. This is an environment where tech can perform. And to all those people trying to compare it to the dot bomb and the tech wreck, what they need to keep in mind is in this environment with 8% inflation, and that'll probably drop down to 6 or 4% by the end of the year if we're lucky, money is still effectively free. In other words, it costs you not to borrow. If you can borrow at 5% and inflation is 8%, it costs you money not borrowing. That was not the case during the dot-com crash in 2000, where the 10-year yield peaked out at 6.8% and inflation was running well below that, which meant money had a real cost, which meant that the valuations of those stocks, which were much higher than they were at the peak a few months ago, could not be substantiated because the cost of capital was too high to keep burning money for some of these startups and be able to raise money in a closed credit market. That's simply not the case at present.
No, definitely. I like how you noticing that because I've talked about it, right? We can relate it to the .com, but it's also different. And I like how you're pointing at the exacts there. One of the things that we saw recent Jay Powell's comments yesterday talking about how he can't guarantee the soft landing, and I don't think anybody can guarantee that one. But how did you see our inflation data come in, and how are you seeing inflation right now in the environment we're in?
Yeah, I have a non-consensus view here. I mean, people are still saying, well, it's so elevated. The PPI and CPI was too hot. I mean, PPI came in below expectations. CPI came in above expectations, but below last month. And that's the key thing. Both of them came in below last month. It's pretty sanguine. The most important thing you need to know about inflation, if you look back at the CPI and PPI numbers of April of last year and then May of last year, what you saw is they started to rise pretty decently in April, but in May they skyrocketed. So why is that helpful? Because the base effects, meaning the comps year on year going forward, are going to get much easier. So the odds of seeing a plus 8% or even potentially a plus 7% in the next print are very low, because the spike was so dramatic in May of last year. So when we come up on May, it's going to be hard to be, we could be plus 5, plus 4. No one's looking for that. And that's going to be a third point for the peak inflation narrative. The first 2 points were this week when CPI and PPI both came in lower than last month. So I think we're going to see a continuation of that. That doesn't mean prices at your grocery store are going to go back to what they were 2 years ago. It just means that they're going to go up less quickly and then eventually stop going up and level out at the higher plateau. But wages will follow and have been following, maybe to a slower pace, and it'll kind of level out. And if you consider all the global debt around the world, governments kind of have to do this to devalue that and bring back debt to GDP ratios to a more normalized level.
Yeah, it's something we're definitely going to keep on watch. One thing that I've been looking at is, just yesterday I went to fill up the pump there, and let's just say it was a little bit more expensive than usual. And we're keeping an eye out on all different areas. One area that's going to be interesting, of course.
Well, Mitch, I mean, according to our leadership, they say, well, that's your problem. Why don't you just go out and buy $100,000 Tesla? I mean, what's the problem?
Yeah, that's probably what it is, right? I just don't have the EV. But then I also look at my electricity bill, and that isn't going down either. So I mean, hey,
But Mitch, all you need is $50,000 to put solar panels on your roof. Get with the program.
using natural gas, and I don't think it's going to be too friendly in the wintertime. So
Yeah. No. I look. There's a lot of pain out there, and this inflation is no joke. Some of it was self-inflicted, some of it was exogenous geopolitical. But they are putting 1 million barrels a day on for 6 months. That's been helpful in containing things. And if you keep an eye on that rig count every Friday, Mitch, and what you're going to see is that we're up about 175% in rigs off the pandemic lows. We're approaching pre-pandemic rig count levels, and that supply is going to come back online, and we can't get it soon enough.
yeah, I mean, we keep watching out for what happens in China, right? Does demand come back too? I mean, we need kind
Yeah.
of that reopening. I think that's going to be something to keep on watch. We'll see what happens in. And one of the things that kind of was interesting, and we can we talked a little bit about Tesla, so I'm going to transfer us over here into the autos. Toyota earlier this week mentioning how they were seeing signs of trouble in the profitability. A lot of that was supply chain concerns of the materials. Then we saw also Tesla coming out, Shanghai worries of supply. How are you seeing that situation there in the autos?
Yeah, I think the semiconductors in particular has been the biggest problem. Yeah, you have the input cost of energy for a lot of the parts as well. But I looked at this report from Compass that I referenced on my video cast last night. You can check that out. And if you dig under the surface, even with the shutdowns, I think what we're going to see is this supply chain shortage is going to turn into, semiconductor shortage is going to turn into a semiconductor glut in the next 18 to 24 months. And again, that's non-consensus, but they kept those factories open in Shanghai, going kind of around the clock. They had the workers sleeping in the factories, et cetera. So I do think that we see you look at Global Foundries earnings this week alone, knocked it out of the park. And I think we've got a lot of people racing. The other thing is, many of these companies put in 2 and 3 and 4 times orders because they sense the shortage. And once that supply comes back online and they realize they don't need that much, they were just trying to get ahead of the line, you're going to see a lot of canceled orders, and you're going to see those chips flow out to the automakers, and the pent up demand from the last 2 years where they've got to refill the dealer inventories, and then they got to meet with years of backed up pent up demand. If you walk into a Range Rover dealer right now, they'll say, okay, yeah, we'll order your car and you can come pick it up in 8 to 12 months. There's a ton of that business, and I think it's going to be a huge opportunity for auto parts suppliers in particular. I think you and your viewership and followers may want to take a look at that group, because there are a number of companies that have been left for dead in that group, and may represent some value opportunity if you can stomach some short-term volatility for the next 3 to 6 months. We don't know when the hockey stick is going to turn on the semiconductor supply, but when it does, all that's needed for them to flourish is the OEMs, the Fords, the GMs, et cetera, to get back to full production to meet their demand that's already in place. And then, you get the semis, these part suppliers are going to absolutely fly off the mats. They've been kind of beaten up because they can't sell to the OEMs if the OEMs can't produce cars, and the OEMs can't produce cars until they have chips. And I think those chips are certainly going to come in the second half of this year. But right now, some of these companies are trading like the chips are not going to come for 2.5 years. And if that's the case, we got a lot more problems than that. And I certainly don't think that's the case. I think the higher likelihood in 2.5 years is we've got a semiconductor glut like we've never seen before.
Something to keep on watch. I mean, I've been waiting to see what happens there. I mean, just to kind of mention, I mean, the Ford, the EV truck coming on out later this year. Also, Fisker going to be coming out with their vehicle in November. So something to keep in mind, right? I think there's going to be some catalyst that also comes into play, and some mentions of these EVs later in the year. We also don't know what's going on with that Tesla Cybertruck, right? I mean, that could come out anytime soon. And just to mention, I mean, what happened to the Tesla Semi? I don't know if you know something that I don't know, Thomas, but I feel like that has also subsided, but it could come back into play, right?
I think that maybe the R&D went into the purchase price of Twitter, but we'll find out how that plays out.
They took a break. Let's just say that. And then they might have been taking some look at the Twitter. How do you feel about that Twitter situation? Do you think this is something that we should just kind of maybe risk off type of situation now? But I mean, it's
look, I think he's going to retrade it. I think he's going to retrade it, and I think he's going to get away with it because they have no choice. So he's got them boxed as he had them boxed with taking a tender to the shareholders before they finally approved it. And my guess is, we don't know what percentage of bots there are on Twitter, but my guess is it's more than 5% that they publicly disclosed in the filings, and Musk completely boxed them. And my guess is the final price is a bit lower. So, there'll be a lot of litigation. There'll be a lot of headaches, but he'll get it done because it's Elon Musk and he just tends to get things done. One thing though, Mitch, I would draw attention to your buyers because, you are to your viewers, because you are in the last couple of days, I kind of touched on it at the top of the hour, seeing a biotech as the top performing sector the last few days. I think there was a sea change, not only with the rates, coming below 3%, the 10-year yield and risk on, et cetera. I think the Pfizer purchase of Biohaven for $11.6 billion was a sea change. And that lit the fire for animal spirits in the market. It put boards of big pharma companies all across the country on notice. If you don't buy these cheap companies, your competitors will. And that's been a major catalyst historically for the biotech sector. There was no deal flow up until this week. And all of a sudden, a big one was done. All of those boards and management are now going to get fear of loss. I think you're going to see a lot more deals. And that's going to create a lot of interest for the XBI when you consider almost 20% of them, particularly the small ones, their enterprise value is lower than their cash value. They're trading at a discount to cash. And the last 4 times this has happened since 2000, it's resulted in a huge rally. And the last type of rally I could think of that's exactly like what we're seeing now is in 2015 to 2016, the XBI biotech ETF collapsed over 50% in anticipation of Fed rate hikes. And it finally, because people think that if rates are going up, biotech can't perform, tech can't perform. But the facts just don't bear that out, because after the second hike, the XBI found its bottom. And over the next 2 years, while the Fed's funds rate went from 25 basis points to 225 basis points, the XBI ETF went up over 140% off of those lows. And I think we could potentially see a similar situation. The XBI has fallen 60% in the last year in anticipation, in fear of the tightening cycle. We've now got 2 tightenings under our belts. The M&A animal spirits are coming back. You have the PDUFA, potential drug approvals in June. A lot of catalysts here. So long as that 10-year stays below 3, I think the game could be on, and I think we could see a multi-year recovery in that sector. And it's nice to finally see it working, even if we were a handful of weeks too early and wound up with a little stinky finger there.
There you go. The old mute trick. There you go. That's what happened there. But no, I'm watching the XBI lows there, and I see the support there right around the pandemic time and also around the 2018 drop here that we had here. And so it's right around those same levels. We'll see if we can get this XBI to start bouncing. It looks interesting to me. I'll definitely keep watch of this. But I wanted to thank you once again, Thomas Hayes, for joining us, the founder and chairman, managing member of Great Hill Capital. Thank you for coming in, and also thank you also for the insight that you gave us. I'm going to still remember what you just gave us about the .com era and then the difference of kind of the lending of the money. I think that's an important factor there. Appreciate you like always, Tom.
Thanks, Mitch. Appreciate coming on with you. See you soon.
See you soon. All right, guys, let's go ahead.